Central banks, such as the Federal Reserve, European Central Bank, and Bank of Japan, influence currency values through monetary policy. Actions like raising interest rates or reducing the money supply can strengthen a currency, while lowering interest rates or increasing the money supply can weaken it. Statements and meeting minutes from central banks provide insights into future monetary policy decisions, which influence market expectations and currency movements. Political stability and economic performance are also critical factors. Political events, such as elections, government policies, and geopolitical tensions, can significantly impact currency values. A stable political environment generally favors a currency, whereas instability can lead to depreciation. Economic performance indicators, such as trade balances, fiscal policies, and foreign direct investment, also affect currency strength. For instance, a trade surplus, where exports exceed imports, can boost a currency, while a trade deficit can weaken it. Market sentiment and news are integral to fundamental analysis. Market sentiment reflects the overall attitude of investors towards a particular currency and is influenced by news events, economic reports, and geopolitical developments. Positive sentiment can drive currency appreciation, while negative sentiment can lead to depreciation. Real-time news sources and economic calendars are essential tools for tracking events that can impact currency markets. The process of fundamental analysis involves several steps. First, traders gather and analyze economic data from reliable sources such as government reports, central bank releases, and financial news outlets. Understanding the context of this data is crucial, as it requires considering the broader economic environment and historical trends. For example, understanding how current inflation rates compare to historical averages can provide insights into potential future central bank actions. Using this information, traders forecast future currency movements, such as anticipating an appreciation if indicators suggest an upcoming interest rate hike. Finally, traders make informed trading decisions based on their analysis, often combining fundamental analysis with technical analysis to identify optimal entry and exit points. Fundamental analysis offers several advantages. It provides a comprehensive understanding of the factors driving currency value and helps anticipate long-term market trends based on economic fundamentals. This method is particularly useful for making informed decisions during significant economic events. However, fundamental analysis can be complex and time-consuming due to the vast amount of data to analyze. Market reactions to economic data can be unpredictable and influenced by short-term sentiment, and a deep understanding of global economics and geopolitical factors is required. In conclusion, fundamental analysis is a powerful tool for forex traders, enabling them to make informed decisions based on economic and political factors that influence currency values. By staying informed about key economic indicators, central bank policies, and global events, traders can anticipate market movements and develop strategies to capitalize on them. Combining fundamental analysis with technical analysis can further enhance trading effectiveness, providing a well-rounded approach to navigating the forex market. Always take calculated risk. In the realm of Forex and gold trading, brokers play a crucial role by providing platforms and services that enable traders to buy and sell currencies and precious metals. There are several types of brokers catering to different trading needs and preferences. Understanding these types can help traders choose the broker that best aligns with their trading strategies and objectives. The first type of broker is the market maker. Market makers create a market for traders by setting bid and ask prices and standing ready to buy or sell at those prices. They essentially act as counterparties to traders' transactions, which means that they can provide liquidity even when there are no immediate buyers or sellers in the market. Market makers often offer fixed spreads, which can be beneficial for traders looking for price certainty. However, since they are the counterparty to trades, there can be potential conflicts of interest, as the broker may benefit from traders' losses. Another type of broker is the Electronic Communication Network, ECN, broker. ECN brokers connect traders directly with other participants in the market, such as banks, financial institutions, and other traders. This means that traders can get access to the best bid and ask prices available in the market, which often results in tighter spreads. ECN brokers typically charge a commission on trades instead of widening the spread. This type of broker is ideal for traders who prefer transparency and direct market access, particularly those who employ high-frequency or scalping strategies. Straight-through processing, STP, brokers are similar to ECN brokers in that they route traders' orders directly to liquidity providers. However, STP brokers do not necessarily match orders with other traders but rather send them to their pool of liquidity providers, which can include banks and other brokers. STP brokers may offer variable spreads depending on the liquidity available from their providers. This type of broker provides a more seamless trading experience and can be a good choice for traders who value direct access to market liquidity without the potential conflicts of interest seen with market makers. For traders focusing on gold trading, some brokers specialize as commodity brokers. These brokers provide platforms that facilitate trading in various commodities, including gold. They offer access to gold futures, options, and spot markets. Commodity brokers often provide specialized tools and research that cater specifically to commodity traders. They are suitable for those who require detailed market analysis and hedging options in the commodities space. Finally, multi-asset brokers offer a wide range of trading instruments, including forex, gold, stocks, indices, and other commodities. These brokers cater to traders looking for diversification across different asset classes from a single platform. Multi-asset brokers typically offer comprehensive trading tools and resources, making them suitable for traders who want to manage a diverse portfolio. In summary, the choice of a forex and gold trading broker depends on the trader's specific needs and trading style. Market makers provide liquidity and fixed spreads, while ECN and STP brokers offer direct market access with potentially tighter spreads. Commodity brokers specialize in the gold market, and multi-asset brokers provide a wide range of trading instruments. Understanding the differences between these brokers can help traders select the right partner for their trading endeavors. The market is active. The correlation between gold and the forex market is a nuanced relationship influenced by various economic, geopolitical, and market factors. Understanding this correlation can offer valuable insights for traders and investors aiming to optimize their strategies. Firstly, gold is often considered a safe haven asset, meaning it tends to appreciate during times of economic uncertainty or geopolitical instability. This inverse relationship is particularly evident with major currencies like the US dollar, USD. When confidence in the global economy wanes, investors flock to gold as a store of value, leading to its price increase. Consequently, the demand for the USD may decline as investors seek safety in gold, causing the dollar to depreciate. This inverse correlation can be observed during financial crises, political turmoil, or periods of high inflation, where gold prices surge while the USD weakens. Secondly, gold and certain currencies share a more direct correlation due to their economic ties. For instance, currencies of countries that are major gold producers, such as the Australian dollar, AUD, and the South African rand, ZAR, often move in tandem with gold prices. When gold prices rise, these countries' export revenues increase, strengthening their currencies. Conversely, a drop in gold prices can weaken their currencies. Traders often monitor gold prices to predict movements in these currencies, leveraging this correlation to make informed trading decisions. The relationship between gold and forex markets is also influenced by central bank policies. Central banks hold gold reserves and engage in monetary policies that can impact both gold prices and currency values. For example, during periods of quantitative easing, QE, or low interest rates, the value of fiat currencies may decline, making gold more attractive as an inflation hedge. As a result, gold prices rise while currencies depreciate. Conversely, when central banks tighten monetary policy or raise interest rates, fiat currencies tend to strengthen, and gold prices may fall. Traders keep a close eye on central bank announcements and policies to anticipate these shifts in the market. Moreover, the correlation between gold and the forex market is shaped by inflation expectations. Gold is traditionally seen as a hedge against inflation, retaining its value when the purchasing power of currencies declines. When inflation expectations rise, demand for gold typically increases, driving up its price. This increased demand can result in the depreciation of currencies, particularly those most affected by inflation. Forex traders use inflation indicators and economic reports to gauge potential impacts on currency values and gold prices, adjusting their positions accordingly. Lastly, the broader macroeconomic environment plays a critical role in the gold-forex correlation. Factors such as global trade dynamics, commodity prices, and investor sentiment all contribute to the interplay between gold and currency markets. For example, in times of economic expansion, higher industrial demand for commodities can drive up gold prices, while strong economic performance can bolster certain currencies. Conversely, during economic downturns, the flight to safety can lead to a stronger gold market and weaker currencies. In summary, the correlation between gold and the forex market is multifaceted, driven by safe haven dynamics, economic ties of gold-producing countries, central bank policies, inflation expectations, and broader macroeconomic conditions. Understanding these relationships enables traders and investors to make more informed decisions, leveraging the interplay between gold and currency markets to optimize their trading strategies. Our expert advisor is analyzing candles formed by the market. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade Forex and gold here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. The Bank of England, BOE, has a long and significant relationship with gold, playing a pivotal role in the global gold market. Established in 1694, the BOE has historically been one of the key institutions in managing gold reserves, both for the United Kingdom and other countries. Its gold vaults are among the largest and most secure in the world, housing not only the UK's gold reserves but also substantial holdings for various other central banks and international organizations. The BOE's role in gold began to solidify in the 19th century with the establishment of the gold standard. Under the gold standard, the value of the British pound was directly linked to a specific quantity of gold, and the BOE was responsible for maintaining this parity. This system provided a stable currency exchange environment, which facilitated international trade and economic stability. Although the gold standard was eventually abandoned in the early 20th century, the BOE continued to manage significant gold reserves. Today, the Bank of England remains a key player in the global gold market primarily through its custodial services. The BOE offers secure storage facilities for gold bars in its underground vaults, which are renowned for their security. These vaults are located deep below the streets of London and contain hundreds of thousands of gold bars, making it one of the largest repositories of gold in the world. The BOE provides custodial services not only for the UK but also for numerous foreign central banks and international financial institutions, ensuring the safety and integrity of their gold holdings. In addition to storage, the BOE facilitates the trading of gold. It acts as an intermediary for gold transactions, leveraging its reputation and infrastructure to ensure that trades are executed smoothly and securely. This role is crucial in maintaining the liquidity and efficiency of the gold market. The bank also plays a part in the London bullion market, one of the world's major gold trading centers, by helping to set standards and practices that govern the trading and settlement of gold. The BOE's gold reserves serve as an important financial buffer and a means of diversifying the national reserves. Gold is seen as a hedge against inflation and currency devaluation, providing financial stability in times of economic uncertainty. The BOE periodically reviews its gold holdings as part of its broader strategy to manage the UK's foreign exchange and reserve assets. Furthermore, the Bank of England's involvement in the gold market extends to policy influence. Through its actions and communications, the BOE can impact gold prices and market perceptions. For instance, decisions on interest rates and monetary policy, while primarily aimed at controlling inflation and supporting economic growth, can indirectly affect gold prices. A lower interest rate environment, often associated with a weaker currency, can lead to higher gold prices as investors seek safe haven assets. In summary, the Bank of England plays a multifaceted role in the global gold market, from serving as a secure custodian and facilitator of gold trading to influencing market conditions through its monetary policies. Its historical and ongoing involvement underscores the importance of gold in global finance and the trust placed in the BOE by countries and institutions worldwide. Light discussion on various aspects of trading, from risk management to mindset and strategy, that are of great value to everyone, especially new traders. The Bank of Japan, BOJ, Japan's central bank, has a nuanced relationship with gold, playing a significant role in managing the country's gold reserves and influencing the broader gold market through its monetary policies. The BOJ, established in 1882, has traditionally focused on maintaining financial stability, implementing monetary policy, and ensuring the smooth functioning of payment and settlement systems in Japan. Historically, the BOJ's involvement with gold was prominent during periods when gold played a central role in the global monetary system. Like many other countries, Japan was on the gold standard in the early 20th century, which required the BOJ to maintain substantial gold reserves to back its currency. This system linked the value of the Japanese yen directly to a specific amount of gold, providing a measure of monetary stability and facilitating international trade. Although the gold standard was abandoned globally during the 20th century, the BOJ continues to hold gold as part of its foreign exchange reserves. Gold is considered a strategic asset by the BOJ, providing a hedge against inflation, currency devaluation, and financial instability. While the exact amount of gold held by the BOJ is subject to periodic disclosure, it forms a relatively small but important part of Japan's overall reserves, which are primarily composed of foreign currencies like the US dollar. The BOJ's monetary policies can indirectly impact the gold market. Japan has experienced prolonged periods of economic stagnation and deflation, leading the BOJ to adopt unconventional monetary policies such as quantitative easing, QE, and negative interest rates. These policies, aimed at stimulating economic growth and combating deflation, tend to weaken the yen and lower interest rates. In turn, a weaker yen and lower interest rates can make gold more attractive to investors as a non-yielding asset, thereby influencing global gold prices. Moreover, the BOJ's approach to monetary policy often serves as a benchmark for other central banks. When the BOJ implements significant policy changes, such as large-scale asset purchases or interest rate adjustments, it can set precedents that affect global market sentiment, including the demand for gold. Investors closely monitor the BOJ's actions and statements for indications of future policy directions, which can create ripple effects in the gold market. In terms of operational involvement, the BOJ does not engage in gold trading in the same way that some other central banks do. Instead, it focuses on the secure storage and prudent management of its gold reserves. The BOJ ensures that its gold holdings are safe and can be liquidated if necessary to stabilize the economy or the financial system. Additionally, Japan's gold market is supported by a robust infrastructure, including the Tokyo Commodity Exchange, TOCOM, where gold futures are traded. While the BOJ itself does not directly participate in these markets, its policies and the overall economic environment it helps shape have a significant impact on gold trading activity in Japan. The BOJ's influence on interest rates, inflation expectations, and currency values can drive investor behavior in the gold market. In summary, the Bank of Japan's relationship with gold is multifaceted, encompassing the management of gold reserves, influencing gold prices through monetary policy, and impacting investor sentiment in the gold market. While the BOJ's direct involvement with gold may be less pronounced compared to some other central banks, its economic policies and strategic reserve management play a critical role in shaping the broader financial landscape in which gold operates. Gold is moving. Using bots in Forex and gold trading offers several benefits, which can significantly enhance trading efficiency, accuracy, and overall profitability. These automated trading systems leverage advanced algorithms to execute trades based on predefined criteria, providing several advantages over manual trading. One of the primary benefits of using bots in trading is their ability to operate 24/7 without the limitations of human fatigue or emotions. Financial markets, especially Forex, operate continuously throughout the week, and bots can monitor and execute trades at any time, ensuring that no trading opportunities are missed due to human unavailability. This constant vigilance is particularly advantageous in highly volatile markets where prices can change rapidly. Bots also excel in executing trades with speed and precision. They can analyze vast amounts of data and respond to market movements in milliseconds, far faster than any human could. This speed is crucial in Forex and gold trading, where even slight delays can result in missed opportunities or suboptimal entry and exit points. By ensuring timely execution, bots can help traders capture favorable market conditions more effectively. Another significant benefit is the elimination of emotional biases from trading decisions. Human traders often fall prey to emotions such as fear, greed, and impatience, which can lead to irrational decisions and significant losses. Bots operate purely on logic and predefined strategies, maintaining discipline and consistency in their trading approach. This objective decision-making process can lead to more reliable and steady performance over time. Bots also provide the advantage of backtesting and optimization. Traders can test their strategies on historical data to assess their viability before deploying them in live markets. This backtesting capability allows for fine-tuning and optimizing trading algorithms to improve performance and reduce risks. By refining strategies based on historical performance, traders can increase their confidence in the bot's ability to handle various market conditions. Additionally, bots can manage multiple trading accounts and strategies simultaneously, offering scalability and diversification. This capability allows traders to spread their risk across different markets and strategies, enhancing their overall portfolio performance. Automated systems can also adjust their strategies dynamically based on changing market conditions, providing a level of adaptability that can be challenging to achieve manually. In conclusion, The use of bots in forex and gold trading brings numerous benefits, including round-the-clock operation, rapid and precise trade execution, elimination of emotional biases, and the ability to backtest and optimize strategies. These advantages can lead to more disciplined, consistent, and potentially more profitable trading outcomes, making bots an invaluable tool for modern traders. The expert advisor is working. Choosing between manual and automated forex trading depends on various factors, including your trading style, experience level, and personal preferences. Here's a detailed comparison to help you understand the differences and make an informed decision. Manual forex trading. Manual trading offers significant control and flexibility. Traders have full control over each trade, allowing for adjustments based on real-time market conditions. This flexibility enables traders to incorporate new information and adapt to changing market scenarios swiftly. Moreover, manual trading enhances your trading skills and understanding of the market through direct experience, providing the opportunity to develop and refine your strategies and techniques. However, manual trading is time-consuming, requiring constant monitoring of the markets, which can be very demanding, especially during high volatility periods. Emotional influences are a major drawback, as traders can fall victim to biases like fear, greed, or overconfidence, negatively impacting trading decisions. Maintaining consistent execution can also be challenging, particularly when dealing with multiple trades or complex strategies. Automated Forex trading. Automated trading, on the other hand, offers efficiency and speed. Automated systems execute trades at lightning speed, capitalizing on even the smallest market movements and handling multiple trades simultaneously without human error. This method eliminates emotional influences, ensuring consistency and discipline by adhering strictly to predefined strategies and rules. Additionally, automated trading saves time, requiring less active monitoring and allowing traders to focus on strategy development and other activities. It also enables backtesting and optimization of strategies on historical data, helping evaluate performance and fine-tune parameters. Despite these advantages, automated trading lacks flexibility, as it cannot adapt to unexpected market conditions or news events not accounted for in the algorithm. The rigid adherence to predefined rules may result in missed opportunities or increased losses. Technical issues, such as software bugs, connectivity problems, or server outages, pose another risk, requiring regular maintenance and updates to ensure optimal performance. There's also the risk of over-optimizing the trading strategy to past data, which may not perform well in live markets, known as curve fitting. Lastly, setting up a reliable automated system demands a significant initial investment in terms of time and money, along with ongoing costs for software updates, data feeds, and possibly VPS hosting. Choosing the right approach. Consider manual trading if you prefer having full control over your trades, enjoy analyzing market data and making discretionary decisions, are willing to invest the time required to monitor and manage trades actively, and value the learning experience and skill development from direct market interaction. Opt for automated trading if you have a well-defined, tested trading strategy that can be coded into an algorithm, want to eliminate emotional biases and maintain consistent execution, have limited time to spend on active trading but still want to participate in the market, and are comfortable with the technical aspects of setting up and maintaining automated systems. Ultimately, some traders use a combination of both methods, leveraging the strengths of each to optimize their trading performance. For instance, they might use automated systems for certain strategies or market conditions while manually trading others. The market is in motion. Before elaborating my trading strategy, I would like to advise new traders that their first target, as a Forex trader, should be to save your capital. Once you have mastered saving your capital, then go for earning from Forex trading. And after getting the skill of earning, you should try to become rich or millionaire by Forex trading. But if you directly want to achieve third level, you can never be profitable. The Forex market is very uncertain. There is no strategy that is always 100% profitable. Risk management, proper psychology and control of emotions are the factors behind my strategy. I may be in loss, in a session or in a day, but not in a week or a month. That's how things work in the life of a Forex trader, and that's the beauty of Forex trading. The key points of my trading strategy are: I do semi-automated trading. It's very difficult for a human to control his psychology and emotions during trading in highly volatile market of Forex. That's why I believe software tools are necessary in Forex trading. I use hybrid approach in my trading that involves human input as well as my own developed expert advisor, EA, algorithm to hint for best entries in trendy and sideways market, keeping in view the running fundamentals of the market. My EA doesn't follow the direction of any daily technical analysis, but looks for suitable entries in both directions, sell and buy. The TP, SL and break-even settings are performed by the EA bot. That really makes my work easy. I constantly keep on improving my EA to improve its performance. I trade all sessions. No doubt, there is more trading volume in the market during New York session and during sessions overlapping. However, good opportunities can come anytime. That's why I love to trade all sessions, looking for nice entries. I take multiple positions in same direction. Whenever I found a suitable entry, I run multiple positions of same lot size and same stop loss, but with different take profits. One of these positions will have open TP, in order to take maximum benefit from big market moves. Sometimes my SLs may trigger in a row, but these net SLs are much smaller than my net TPs. That's what makes me profitable. I do break even of remaining positions after 1 or 2 TP hits. In my trading, when 1 or 2 TPs are hit, I move SLs of all other running positions to break-even level. This may deprive me of taking benefit from my entry, if market retests my entry level and then bounces back in my direction. In this case, I don't take next entry in same direction. I'll wait, and the waiting period sometimes may extend even up to a couple of hours or so, until I found an opportunity in opposite direction. Then I will take my next entry. Low risk and high reward trading makes you a profitable trader. Backtesting trading strategies is a crucial step in the development and refinement of any trading system. It involves applying a trading strategy to historical market data to evaluate its performance over time. By simulating trades that would have occurred in the past, traders can gain insights into the potential effectiveness and profitability of their strategies without risking real capital. The process of backtesting starts with the selection of a trading strategy. This strategy includes specific rules for entering and exiting trades, position sizing, and risk management. Once the strategy is defined, it is applied to historical data to simulate how it would have performed under actual market conditions. This helps traders identify whether the strategy can generate consistent returns and withstand various market scenarios. One of the primary benefits of backtesting is that it allows traders to validate their strategies before committing real money. By testing a strategy on past data, traders can identify potential flaws and make necessary adjustments. This process helps in refining the strategy to enhance its performance and robustness. Additionally, backtesting provides statistical measures such as win rate, average profit, loss, maximum drawdown, and Sharpe ratio, which are essential for evaluating the risk and return profile of the strategy. Backtesting also helps traders understand the historical context and behavior of their strategies. For example, a strategy that performs well in a trending market may not fare as well in a sideways or choppy market. By analyzing historical performance, traders can identify the market conditions under which their strategies perform best and make informed decisions about when to deploy them. This contextual understanding is crucial for adapting strategies to changing market environments. Moreover, backtesting facilitates the optimization of trading strategies. Traders can test various parameters and settings to find the optimal combination that maximizes returns and minimizes risks. For instance, they can adjust the time frames, technical indicators, or stop-loss levels to see how these changes impact the strategy's performance. Optimization helps in fine-tuning the strategy to achieve better results, but it must be done carefully to avoid overfitting, where a strategy performs well on historical data but fails in live markets due to excessive customization. Lastly, backtesting builds confidence in a trading strategy. When traders see consistent and favorable results from backtesting, they are more likely to trust and stick to their strategies during live trading. This confidence is crucial for maintaining discipline, especially during periods of drawdown or market volatility. It reassures traders that their strategies have been rigorously tested and are likely to yield positive outcomes over the long term. In summary, backtesting trading strategies is an essential practice that helps traders validate, refine, and optimize their strategies using historical data. It provides valuable insights into the strategy's performance, helps identify optimal settings, and builds confidence in its application. By thoroughly backtesting their strategies, traders can enhance their chances of success in the dynamic and unpredictable world of trading. Gold is forming its candles. Forex, gold and crypto trading can be facilitated through either traditional brokers or proprietary trading firms, prop firms, each offering distinct advantages and disadvantages depending on a trader's goals, experience, and resources. Understanding the differences between these two options can help traders make informed decisions about where to direct their trading efforts. Brokers provide individual traders with the platform and resources to trade in the market. Brokers typically offer a range of trading accounts, from standard GCN, electronic communication network, accounts, catering to both retail and professional traders. They provide access to various trading tools, educational resources, and customer support, which can be particularly beneficial for novice traders. Brokers earn through spreads, The difference between bid and ask prices, or commissions on trades. This model allows traders to maintain control over their capital, strategies, and risk management. However, trading with brokers requires personal capital, and the potential for loss is directly borne by the trader. In contrast, proprietary trading firms, prop firms, operate differently by allowing traders to trade the firm's capital rather than their own. This setup significantly reduces the financial risk for traders while providing the opportunity to earn a share of the profits. Prop firms usually require traders to pass a rigorous evaluation process to demonstrate their trading skills and discipline. Successful candidates gain access to the firm's capital and resources, such as advanced trading platforms, professional development programs, and mentorship. This model is particularly attractive to skilled traders who lack sufficient personal capital but possess the expertise to generate consistent returns. One of the main advantages of trading with a prop firm is the leverage provided by the firm's capital. Traders can take larger positions than they could with their funds, potentially leading to higher profits. Additionally, prop firms often cover the operational costs, including trading platforms and data feeds, which can otherwise be significant for individual traders. The support and structured environment of a prop firm can also enhance a trader's performance and discipline, thanks to the access to seasoned professionals and a collaborative trading environment. However, trading with prop firms comes with its own set of challenges. The evaluation process to join a prop firm can be stringent, with a focus on risk management and consistency rather than just profitability. Traders may face pressure to meet performance targets and adhere to the firm's risk management policies, which can limit trading flexibility. Furthermore, profit splits between the trader and the firm mean that traders do not retain the full earnings of their successful trades, unlike in personal accounts with brokers. In summary, choosing between a broker and a prop firm depends largely on a trader's individual circumstances and goals. Brokers offer autonomy and full control over trading strategies and profits but require personal capital and bear the full risk of losses. Prop firms, on the other hand, provide the opportunity to trade with substantial capital and professional support, reducing personal financial risk but often at the cost of profit sharing and adherence to strict performance criteria. Traders must weigh these factors to determine which option best suits their trading style and financial objectives. Our expert advisor is reading candles. Trading hammer and inverted hammer candles involves understanding their formation, context within the market, and confirmation signals. These candlestick patterns are indicative of potential reversals and can be powerful tools for traders when used correctly. A hammer candle is characterized by a small body at the upper end of the trading range and a long lower wick. This formation typically occurs at the bottom of a downtrend and signifies a potential bullish reversal. The long lower wick indicates that sellers drove the price down significantly during the session, but strong buying pressure brought the price back up near the opening level. This buying interest suggests that the downtrend may be losing momentum and buyers are starting to take control. To trade a hammer candle, look for confirmation of the reversal signal. This confirmation often comes in the form of a subsequent bullish candle that closes higher than the hammer's close. Entering a long position after the confirmation candle helps reduce the risk of false signals. It's also advisable to place a stop-loss order below the hammer's lower wick to protect against further downside. Additionally, analyzing volume can provide further validation. A hammer candle with high trading volume indicates stronger conviction in the reversal. An inverted hammer candle, conversely, has a small body at the lower end of the trading range and a long upper wick. This pattern usually appears after a downtrend and suggests a potential bullish reversal. The long upper wick demonstrates that buyers pushed prices higher during the session, but sellers managed to bring it back down. Nonetheless, the buying interest signals that the downtrend might be weakening. Trading an inverted hammer involves similar steps to trading a hammer candle. Wait for a confirmation candle that closes higher than the inverted hammer's close to validate the potential reversal. Enter a long position after the confirmation and place a stop-loss below the inverted hammer's low to limit risk. Volume analysis can again be useful. A significant volume on the inverted hammer day can indicate a more reliable reversal signal. Both hammer and inverted hammer candles are most effective when they appear at key support levels or within a broader technical context, such as at the end of a retracement in an uptrend. Combining candlestick analysis with other technical tools like moving averages, trend lines, or Fibonacci retracement levels can enhance the accuracy of these patterns. Patience and discipline in waiting for confirmation and managing risk are crucial for successfully trading hammer and inverted hammer candles. The key to trading success is emotional discipline. Leverage is a powerful tool in forex and gold trading that allows traders to control large positions with a relatively small amount of capital. By using leverage, traders can amplify their potential profits, but it also comes with the increased risk of significant losses. Understanding how leverage works and managing its use effectively is crucial for successful trading. In essence, leverage is the ratio of a trader's own capital to the borrowed capital used for trading. It is commonly expressed in ratios such as 50 to 1, 100 to 1, or even 500 to 1. For example, with a leverage ratio of 100 to 1, a trader can control a $100,000 position with just $1,000 of their own funds. This capability allows traders to participate in larger trades than they could with their own capital alone, potentially leading to greater profits from small market movements. Leverage significantly magnifies both potential gains and potential losses. While a small price movement in the desired direction can result in substantial profits, an adverse movement can quickly deplete a trader's capital. This dual-edged nature of leverage makes risk management paramount. Traders must carefully consider their leverage ratio and ensure they do not overextend themselves. Using too high a leverage ratio can lead to margin calls, where the broker requires additional funds to cover potential losses, or even the forced closure of positions to prevent further losses. Margin is closely linked to leverage and refers to the amount of money required to open and maintain a leveraged position. Brokers set margin requirements based on the leverage ratio, meaning that higher leverage requires a lower margin. For instance, with 100 to 1 leverage, the margin requirement would be 1% of the total position size. While this enables traders to use less of their own capital, it also means that their account is more susceptible to rapid changes in equity due to market fluctuations. Effective use of leverage requires a disciplined approach to risk management. Traders should use stop-loss orders to limit potential losses and protect their capital. Setting appropriate stop-loss levels helps to ensure that a position is closed before losses exceed a predefined threshold. Additionally, traders should carefully consider their position size relative to their account balance and avoid using the maximum available leverage. By using lower leverage, traders can reduce the risk of significant losses and better manage their overall risk exposure. Furthermore, understanding market conditions and volatility is crucial when using leverage. Markets with higher volatility can lead to larger price swings, which can quickly affect leveraged positions. Traders need to be aware of economic events, news releases, and other factors that can increase market volatility. By staying informed and adjusting their leverage and positions accordingly, traders can navigate the risks associated with leveraging in volatile markets. In summary, leverage is a potent tool in forex and gold trading that allows traders to control large positions with relatively small amounts of capital. While it can amplify profits, it also increases the potential for significant losses. Effective leverage use requires a thorough understanding of risk management, margin requirements, and market conditions. By using leverage judiciously and employing strict risk management practices, traders can harness its benefits while mitigating its inherent risks. Gold is in move. The London and New York trading sessions are two of the most significant periods in the Forex market, each with unique characteristics that influence trading strategies and market behavior. Understanding the differences between these sessions can help traders optimize their activities and capitalize on the distinct opportunities each session presents. The London session, which runs from 8 a.m. to 4 p.m. Greenwich Mean Time, is the most active Forex trading period. London has historically been a major financial hub, and this session sees a high volume of transactions and liquidity. The London session overlaps with the Asian and New York sessions, making it a critical time for trading. During this period, traders can expect high volatility and significant price movements, especially in currency pairs involving the British pound, GBP, the euro, EUR, and the Swiss franc, CHF. Economic data releases from the UK and the Eurozone often impact market activity, and traders need to stay informed about these announcements to anticipate potential market shifts. Key features of the London session include its liquidity and the variety of trading opportunities available. The high trading volume means that orders are executed quickly and with minimal slippage. This liquidity also allows for tighter spreads, reducing trading costs. Additionally, many of the world's largest banks and financial institutions are active during this session, contributing to the deep liquidity and dynamic market movements. Traders can take advantage of the heightened volatility by employing strategies such as trend trading or breakout trading, which rely on significant price movements. In contrast, the New York session runs from 8 a.m. to 5 p.m. Eastern Standard Time. It begins as the London session is winding down, creating a period of overlap from 8 a.m. to 12 p.m. Eastern Standard Time, which is one of the most active times in the Forex market. The New York session is influenced heavily by economic data releases from the United States, including reports on employment, GDP, and consumer sentiment. These releases can cause sharp market movements, particularly in USD currency pairs. The New York session is also known for its volatility, but it tends to be driven by different factors compared to the London session. The focus shifts more towards U.S. economic news and developments, which can create significant trading opportunities. Major U.S. financial institutions and hedge funds are highly active during this time, contributing to large trade volumes and liquidity. The New York session's impact on market sentiment can be profound, often setting the tone for the rest of the trading day. One key aspect of the New York session is the afternoon low, that can occur after the London market closes. This period may see reduced volatility and lower trading volumes as European traders exit the market, leading to quieter market conditions. However, this can also be an opportunity for traders to reassess positions and plan for potential movements when the Asian markets open. In summary, the London and New York trading sessions are pivotal periods in the Forex market, each with its own dynamics and opportunities. The London session is characterized by high liquidity, volatility, and significant price movements influenced by European economic data.